You are watching Market Pulse Daily. Today is Thursday, May 21, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. AI IPOs spark liquidity fears. Is a deflationary bust looming? Today's agenda: AI IPO liquidity crunch, deflationary bust fears, inflation and Federal Reserve policy, geopolitics and commodities, crypto market outlook, market update. First, let's talk about the massive wave of AI IPOs on the horizon. We're seeing a convergence of major AI and space companies, including OpenAI, SpaceX, and Anthropic, preparing for massive public offerings. The combined capital raise is expected to be around about $200 billion. This isn't just about individual company valuations, it's about the sheer volume of cash these IPOs are poised to pull from the broader market. This massive capital raise creates a significant liquidity vacuum. When so much money is funneled into a few large IPOs, it means less cash is available for other investments, especially riskier assets like tech stocks and cryptocurrencies. It signals a potential peak in the current AI hype cycle, where private capital is moving to public markets, potentially marking a top. While these IPOs are still in the planning stages, the anticipation is already causing concern. Analysts are warning of a potential rotation out of speculative AI infrastructure and toward assets that are generating actual cash flow. The market is beginning to price in the risk that these IPOs could trigger a broader tech sector correction. Keep a close eye on the S-1 filings for OpenAI and SpaceX for confirmed IPO timelines and details. Any signs of insider profit-taking or a slowdown in the circular funding model between AI firms and hardware vendors like NVIDIA will be critical indicators. The sheer scale of upcoming AI IPOs presents a significant risk of draining market liquidity, potentially triggering a broad sell-off in tech and other risk assets. This AI liquidity crunch ties directly into another major concern, a potential deflationary bust. The current market narrative suggests we're in the final parabolic stage of a long bull run, with a potential peak by late 2026. This is followed by a forecast of an 8% deflationary bust, which some analysts believe could be worse than the 2008 financial crisis. This scenario is driven by extreme leverage in private credit and banking sectors. A deflationary bust means a sharp, widespread drop in prices and economic activity. This happens when there's too much debt and not enough money to pay it back, leading to a cascade of defaults and asset liquidations. It's the opposite of inflation, where prices rise. Deflation means prices fall, but in a destructive way that cripples economies. While the market is currently in a melt-up phase, the underlying concern about this potential bust is creating a wall of worry. This skepticism, even amidst a rally, suggests that institutional sentiment is cautious. The expectation of a violent unwind of risk assets, including crypto, is a significant factor for investors to consider. Pay close attention to any resolution in the Iran conflict, as a normalization of oil prices could be the catalyst that exposes the fragility of private credit. Also, monitor the sustainability of AI capital expenditures. Any signs of a slowdown could precede a broader tech sector correction. The current market rally may be a final euphoric push before a catastrophic deflationary crash, driven by excessive leverage and a potential unwinding of risk assets. Amidst these deflationary fears, inflation itself is proving stubbornly persistent. We saw April's Consumer Price Index, or CPI, inflation data come in at 3.8%. This is the highest reading we've seen since May of 2023, and it certainly shocked many market participants. Core CPI, which strips out volatile food and energy prices, is still running at 2.8% over the past year. This hot inflation data puts direct pressure on the Federal Reserve. It makes it much harder for them to even consider cutting interest rates, and likely reinforces their commitment to maintaining a hawkish stance, meaning they're focused on keeping rates higher for longer to fight price increases. This impacts everything from borrowing costs to investment returns. Markets reacted with concern to this inflation surprise. The immediate effect is a repricing of interest rate expectations, with traders now less optimistic about near-term Federal Reserve rate cuts. This can lead to increased yields on government bonds and put downward pressure on growth stocks that are sensitive to higher borrowing costs. Keep a very close eye on any commentary from Federal Reserve officials this week. With Stephen I. Murrin resigning from the board, any remaining voices will carry significant weight. Also, watch for any shifts in market expectations regarding the timing of potential rate cuts. Sticky inflation at 3.8% means the Federal Reserve is likely to stay on its hawkish path, keeping interest rates higher for longer and impacting investment strategies. And speaking of inflation, geopolitical tensions are adding fuel to the fire. And speaking of inflation, geopolitical tensions are adding fuel to the fire. The escalating conflict in the Middle East continues to have a significant impact on markets, particularly oil prices. WTI crude has surged above about $99 a barrel, with Brent crude also trading elevated. This reflects a clear supply risk premium being priced in by traders. Higher oil prices have a ripple effect across the economy. They directly contribute to inflation, making everything from transportation to manufacturing more expensive. This can force central banks to remain hawkish, even if other economic indicators are weak, and it also drives demand for safe haven assets like gold, as investors seek protection against currency debasement and economic uncertainty. Stock markets have faced pressure from these geopolitical risks and hot inflation data. The S&P 500 is trading at 7,433, higher on the day, up about 1%. Gold is trading at about $4,520, slightly lower on the day. The key event to watch here is the ongoing geopolitical situation in the Middle East. Any further escalation or de-escalation will directly impact oil prices. Also, monitor how central banks respond to this persistent inflation, as their actions will dictate the broader market direction. Geopolitical tensions are driving oil prices higher, exacerbating inflation concerns and boosting demand for safe haven assets like gold. Now let's turn our attention to the crypto market, which is showing surprising resilience. Despite the broader market volatility driven by inflation and geopolitical fears, Bitcoin has recovered to trade around about $77,956. The Fear and Greed Index is currently at 29, indicating fear, which often suggests oversold conditions and potential for a bounce. We're also seeing continued institutional accumulation, with MicroStrategy acquiring another 13,927 Bitcoin. This resilience is partly due to the ongoing narrative of fiat debasement and the increasing adoption of Bitcoin as a hard asset. Furthermore, the maturation of crypto markets, with whales utilizing ETFs for tax and estate planning, suggests a shift from speculation to long-term capital allocation. This institutional integration provides a structural floor for prices. The crypto market has shown up about 2% gain in total market cap over the last 24 hours, indicating a recovery momentum. While there were significant liquidations from leveraged positions during a recent volatility spike, the overall trend shows capital flowing back into the space, with Bitcoin dominance remaining strong at over 5.8%. We'll be watching weekly ETF inflow and outflow reports closely for signs of continued institutional demand. Also, keep an eye on any further developments in X's integration of crypto content, which signals growing mainstream adoption. The about $76,000 level for Bitcoin remains a key technical indicator for the end of the bear market. Bitcoin is demonstrating resilience, supported by institutional inflows and the ongoing narrative of fiat debasement, suggesting a strong long-term outlook despite short-term market fears. Today's live market snapshot: metals, crypto, stocks, and bonds. Now for our daily financial market update. Here is where the key asset classes stand as of today. Gold is trading at about $4,520, slightly lower on the day, and is slightly lower over the past 5 sessions. Silver is at about $75, slightly lower today, and lower over the past 5 sessions. In crypto, Bitcoin is at about $77,700, slightly higher on the session, and slightly higher over the past 5 sessions. Ethereum is at about $2,150, slightly higher today. Other major crypto: Solana at about $87, slightly higher. BNB at about $652, slightly higher. XRP at about $1.374, slightly higher. On equities, the S&P 500 at 7,433 higher. The Nasdaq at 26,270.4 higher. The Dow at 50,009.3 higher. Internationally, the DAX at 24,642.7, slightly lower. The Nikkei at 61,684.1, strongly higher. The FTSE at 10,387.3, slightly lower. On the bond side, the 10-year U.S. Treasury yield is at 4.6%, lower on the session, and the 30-year yield is at 5.1%, lower. Elevated yields continue to place pressure on risk assets and growth valuations. Rounding out the macro picture, WTI crude at about $99 per barrel, higher. The dollar index at 99.31, slightly higher. euro-dollar at 1.161 flat. The overall tone is risk-on. Equities and crypto are both bid, suggesting investors are positioned for continued upside in the near term. The market is caught between soaring inflation, geopolitical risks, and the potential for a massive liquidity drain from AI IPOs. Investors need to be nimble, focusing on hard assets and defensive strategies as we navigate this complex landscape. Thank you for your attention, and we will see you again tomorrow.